By every headline, retirement in America looks fine. The stock market's near record highs. 401,000 balances are up. Financial advisors keep telling you to just stay the course. But underneath all of that, there's a $6.5 trillion hole that almost nobody is talking about. And that hole is public pensions. Because while everyone's arguing about Social Security running out of money, there's a much bigger, much quieter crisis sitting right next to it. And this one isn't decades away. It's already happening in cities and states across the country. Here's the thing about pensions. They're a promise. A government worker spends 20, 30 years on the job, and in exchange, they're told a check will be waiting for them every month for the rest of their life. Simple enough. Except somewhere along the way, the people managing that promise decided math was optional. Let's zoom out first. Public pension funds in the United States are supposed to be funded at 100%, meaning for every dollar they'll eventually owe a retiree, they should have a dollar sitting in the fund today, growing. But according to recent data, the average state pension fund is only funded at around 75%. And some states are far worse. Illinois sits at roughly 44%. New Jersey isn't much better. That means for every dollar these states have promised their retired teachers, police officers, and firefighters, they're missing a quarter to more than half of the money to actually pay it. And it gets worse, because that $6.5 trillion figure isn't a flashy doomsday number some analysts made up to get clicks. It's the actual calculated shortfall between what's being promised and what's actually funded, using the pension fund's own assumptions. And those assumptions are optimistic to begin with. Because here's how pension math works behind the curtain. Every fund assumes a certain rate of return on its investments, usually somewhere around 7%. And that number determines how much the state needs to contribute today to cover tomorrow's payouts. The problem is, 7% is a fantasy in a world of lower long-term growth expectations. So when funds miss their target, which they frequently do, the gap doesn't just disappear. It gets pushed onto taxpayers, or it gets pushed onto future retirees, or both. And just like in the corporate world, when the numbers don't add up, the first instinct isn't to fix the problem, it's to change the assumptions. Some states have actually lowered their expected rate of return in recent years, which sounds responsible on the surface. But here's the catch. Lowering that assumption instantly increases the size of the reported shortfall, because now you need more money today to hit the same future target. So states are stuck between two bad options. Either keep the fantasy number and pretend everything's fine, or admit the truth and watch the hole get even bigger on paper. Meanwhile, the workforce funding these pensions is shrinking, because decades ago, pension systems assumed a healthy ratio of active workers paying in for every retiree taking money out. But public sector employment growth has slowed, while the number of retirees collecting benefits keeps climbing as baby boomers age out of the workforce. Fewer people paying in, more people pulling out. It's the same demographic math problem that's crushing Social Security, just playing out at the state and local level with way less media attention. And here's where it starts hitting regular people, not just spreadsheets. Because when a pension fund can't meet its obligations, states have exactly three levers to pull: raise taxes, cut services, or cut benefits. And most states are already quietly pulling the first two. Property taxes have crept up in pension-strapped states. School budgets, road maintenance, and public services are getting squeezed to funnel more money into plugging these holes. It's not framed as a pension bailout. It's framed as budget tightening or fiscal responsibility, but follow the money. And a growing share of it is going straight into pension funds that are still underwater. And then there's Illinois, which might be the closest thing to a live case study of what happens when this crisis stops being theoretical. Illinois has one of the worst funded pension systems in the country, and its bond ratings have been downgraded multiple times over the past decade specifically because of pension liabilities. Investors aren't stupid. When a state's largest, fastest growing expense is a legally protected promise it can't actually afford, that state becomes a riskier bet. And a riskier bet means higher borrowing costs, which means even less money available for literally everything else. And this isn't a new phenomenon born out of nowhere. Corporate America already lived through this exact story decades ago. Back in the mid-20th century, private companies routinely offered pensions the same way governments do now. But when the bills came due and the math didn't work, companies did what public pensions largely can't. They froze them, they restructured them, or they dumped the obligation entirely into bankruptcy court. That's part of why traditional pensions have all but disappeared from the private sector, replaced by 401ks that shift the risk from the employer onto the employee. Public pensions never made that shift. They kept the old promise structure, kept the optimistic assumptions, and kept adding new retirees to a system that was already straining under its own weight. Take a single teacher's pension fund as an example of how this plays out on the ground. A teacher pays into the system for 30 years, trusting that the state has been managing that money responsibly the entire time. But if the fund has been underfunded since before the teacher was even hired, the math was broken before they ever started contributing. And when funding gaps like this compound over decades, fixing them isn't a matter of a good year in the stock market. It requires either a massive one-time injection of cash the state doesn't have, or decades of catch-up contributions that eat into every other budget line, year after year. But maybe this is just an Illinois problem. Maybe it's isolated. Except it isn't, because dozens of states and thousands of municipalities are carrying some version of this same structural gap. Some are in better shape, some are in worse shape, but the underlying disease is the same everywhere. Promises made decades ago under rosy assumptions, colliding with a demographic and investment reality that never showed up. And here's the part that should really worry you. Unlike a corporate pension, which can legally be reduced or restructured in bankruptcy, public pensions are often protected by state constitutions, meaning even if a state wanted to renegotiate these promises, in many cases it legally can't. The obligation isn't just a budget line. It's baked into law, which leaves exactly one flexible variable in this entire equation, and that's you, the taxpayer. So while the stock market chases new highs and financial media obsesses over interest rate decisions, there's a slower, quieter crisis compounding in the background. One measured not in daily headlines, but in actuarial reports most people will never read. And it follows the exact same pattern we've seen before. A promise gets made when times are good. The assumptions behind that promise turn out to be too optimistic. And by the time the gap becomes undeniable, the bill has already been handed to someone else. Because this is how these things always play out. Not with a dramatic crash you see coming from a mile away, but with a slow drip of tax hikes, service cuts, and quietly downgraded bond ratings. Until one day people wake up and ask how it got this bad. And by then, the answer is always the same. It was always this bad. Nobody was just looking. So the real question isn't whether this pension gap gets addressed. It's who ends up paying for it, and how long it takes before the rest of the country notices what's already happening in places like Illinois. Because the numbers don't lie, even when the people reporting them do. And if you found this eye-opening, subscribe. Because someone has to actually look at the numbers nobody wants to talk about. And if your state, or your city, or your family has already felt the effects of this, drop a comment. Because sometimes the clearest picture of a crisis doesn't come from a report. It comes from the people already living inside it.